Hi there, welcome to kneppyinvests. On May 13, Xero, New Zealand's favourite company, released their financial year 21 results. I'm finding it really hard to believe that companies are starting to release their financial year 21 results, considering we're only halfway through the year. But anyway, they did, and the market did not like the results at all. Share price fell something like, was it 10-13% on the day? The charts were quite ugly, but the further down the share price falls, the more attractive this company becomes to own because they are still growing. Now, the growth rates are slowing down, and one of the negative things I did find in the results was their performance in the United States. But I'll get into that once we get to that slide. But this is the company I've been following for 8 years. Was a shareholder of this company for a very brief period, and I thought I was the smartest person alive or investor alive when I sold for a small profit around $18, and it's gone up quite a bit since then. So let's get stuck into looking at their financial results. Xero has a market cap of $16.7 billion. Some people think that's high, but when you compare it to, say, Afterpay, which has a market cap of $25 billion, and it's not profitable, burning through a massive amount of cash, you can see the attractiveness around Xero because Xero has a much better runway for growth than Afterpay. Look, this is not a video on Afterpay. If you had asked me whether I would choose to hold Xero Afterpay, it's definitely going to be Xero, although I do have an indirect holding in Afterpay. But again, this video is not about Afterpay. Xero, for the financial year 21, had revenue of $779 million, growing quite quickly. Operating cash flow, $201 million, free cash flow of $62.7, and net profit after tax of $18.2. I have heard some detractors of Xero point to that net profit after tax and say, wow, this company is so overvalued based off the net profit after tax. I typically ignore profit after tax most of the time. So I've just included it here just because it seems like a lot of people are looking at that number. All these numbers are in Australian dollars, so they report in New Zealand dollars. This is a New Zealand company, so I've just where I get these results, not straight from the report. I get these from Guru Focus, and Guru Focus is, in my case, automatically adjusted to Australian dollars, and I'm just too lazy to adjust that to New Zealand dollars. Now let's look at some of their subscribers and user numbers here. Subscribers up 20% to 2.74 million, growing quite quickly there. Average revenue per user down a little bit, 29.3. Would prefer that to be positive, or prefer everything to be positive here. Annualized monthly recurring revenue, 963 million. So that's an annual number, but it's based off monthly recurring revenue, up 17%, and lifetime transaction value, lifetime total value, 7.65 billion, up 38%. Gross margins up slightly as well. So that's another positive. You want to see gross margins trying to get as high as possible, 86%. I would prefer that to be above 90%, but you can't have everything being positive here. That would be fairly unusual. Now, when we look at some of the ratios in regards to Xero, some of these are high. So price to sales, 20.8, price to book, 24.1, PE ratio, now 475, that's not serious. You just ignore that. Now, you don't really value these sort of companies based off the PE ratio. Some people have a hard time understanding that, but yeah, ignore the price to earnings ratio because they could easily quadruple the net profit after tax in 1 year, and that would make the PE ratio look ridiculous. EV to operating cash flow, 84, and EV to EBITDA at 215. So my favorite ratio out of all these is EV to operating cash flow. My second favorite is the price to sales. And we look at both of those ratios, it is on the high side, but this is a highly growing company with a long runway ahead of them, potentially significant growth in the future. But there are a few concerns when I look at their growth, particularly in one of the regions, and that one region is a very important region. One of the most important things when looking at a company like Xero, who are growing throughout the world, is to see how they are actually growing through the world. And the holy grail for most companies would be the United States. They do break that down and actually call it North America, so they include Canada. But the United States is the holy grail. If you make it there, you will have the power to make it anywhere else. They're gaining really good traction in Australia, 1.1 million subscribers, and growth rate, subscriber growth rate, and revenue growth rate above 20%. UK up to 720,000 subscribers, doing really well there. And naturally enough, probably their biggest penetration would be New Zealand, 446,000 subscribers, but still growing, even though I think that would be maturing and we should see the growth rates coming down because I wouldn't say they've saturated the market, but they're nearing saturation there. The most interesting and most important market, USA and Canada, they've lumped them together. 285,000 subscribers, growth rate at 18%. The only disappointing thing here was revenue only grew at 2% for the United States and Canada. I'm not sure, that could be some competitive pressure there, so they've had to reduce the prices potentially. I don't know the full story, haven't quite gone into that much depth. Rest of the world seems to be where they're growing the most. I believe that's mostly South Africa and somewhere else, I forget offhand, but subscriber growth at 40% and revenue growth at 27%, and they've almost catch up to the United States. So seems like the rest of the world is just about to overtake North America. In this slide, I do something I love to do for every single company I do an analysis on, and that is looking at the financial history of a company, looking at the revenue, operating cash flow, and market cap. You'll notice I've left out net profit after tax. There's a main reason I've left net profit after tax. It is something that can be highly manipulated by accounting and management teams because it's the first thing investors go to. They look at the net profit after tax. So they want to be able to manipulate that as much as they can, and they do it legally. The one thing they really don't manipulate as much as profit is operating cash flow or cash flow and revenue. So I just like to look at the growth rate of revenue, operating cash flow, and compare it to market cap. So we'll do that in this slide, and then we'll look at the growth rates of all three in the next slide over different periods. So what you want to see in this graph is an upwards trend. And we see an upwards trend in everything here. Revenues going up, that's the blue bars. Operating cash flow has gone from negative from 2013 to 17 and now has gone positive and is going in an upwards trend, and market cap's going up as well, particularly from 2016. We did see it decreasing between 2014 and 16, and we can see that when we look at the charts. But everything is going up here, everything is in uptrends, and this is exactly what you want to see for a growth company, because this is a growth company just by looking at this. So what I've done in this slide is I've compared revenue and operating cash flow growth rates to the market cap growth rates. So what you want to see here is revenue and operating cash flow growing at quicker rates than market cap. If you see that, there is potential, there might be value there. If you see the opposite, where market cap is growing at a quicker rate than revenue and operating cash flow, that shows you there is potential that the company is overvalued and there's a bit of premium in the share price. So I calculated these growth rates over 5 different periods. The first one was from 2013 to present, then from 2015 to 2021, which was the 6th, the 4-year period, 2017, 2021, the last 2 years, 2019, 2021. And then I calculated a 6-year period from 2013 to 2019. So what I want to see here is any periods where we do see market cap growing at a slower rate than revenue and operating cash flow. And actually, we do see that. In fact, since IPO'd, the market cap has been growing at a slower rate than revenue and operating cash flow. So on the assumption that Xero was fairly priced at the IPO on the ASX, this company could be good value right now because revenue and operating cash flow have been growing at about 50 to 55% per year since 2013, but the market cap has only been growing at 44% per year. So keep that in mind if you think this company is expensive right now. Now, something really interesting. If you look at the period between 2013 and 19, revenue and operating cash flow was growing at 60% per year up until 2019, but market cap was only growing at 37% per year. And that's showing there was a lot of financial expansion, but there was not the share price expansion to match the financial expansion. And that was telling me the best time to buy into Xero was about 2 years ago in 2019, when the market had really not caught on to this growth story of Xero. But what has happened in the last 2 years? So look at that CAGR with the 2 in the brackets. Revenue has grown at 21% per year. Operating cash flow grown at 35%, but market cap has grown at 65% per year. So, in fact, the market cap has gone from 6 billion to 18 billion, so it's tripled in the last 2 years. And that's telling me the market has woken up to Xero over the past 2 years, and it's catching up. The share price, the market cap, is catching up to all that financial growth of the company between 2013 and 19. So at the moment, it still could be a little bit good value right there, but the best value in Xero was 2 years ago in 2019. And we have seen a fair bit of multiple expansion over the past 4 years. So the price to sales ratio has gone from 9 to 20. So the market has gotten on to the Xero story during that time period. So I still think there could be some good value right now, but yeah, the best value was 2 years ago. Now on to the charts for Xero, and the first chart we'll be looking at is the 8-year monthly chart. So this is going back to when they listed on the ASX. A lot of retail excitement in this company when they first listed. The share price went from $5 to $40 in less than a year. I remember back then, so I did have a holding on Xero for a short period of time, and I thought I was the smartest investor because I got up before the share price decreased from $40 to below $20 in 2014. Share price then went sideways for about 3 years. And then we saw a breakout in early part of 2017. So really that was the time to buy. Previous slide I said 2019 was, but we have seen the triple in the share price since 2019. But really the time to get into Xero was 2017 when we saw a breakout in the share price. And that's the time when we started to see fund managers and professionals get interested in Xero. Before then, it was just mostly retail investors. And we know that just by looking at the volume. You can see fairly light volume from when they listed on the ASX to 2017. And that's telling you there's not a lot of fund managers, not a lot of people with a lot of money interested in Xero. You see an explosion in volume from 2017 or late 2017 to now. And that's telling you the interest in this company has been led by fund managers, probably worldwide fund managers and professionals. And when you get worldwide fund managers interested in a company, that's when you get share price appreciation. That's the best time to be holding a company. And we've seen that over the last 4 years. We have seen a bit of pressure in the share price over the last 5 months, but that's understandable because the ending of 2020, we did see the share price of Xero go from $100 to a top of nearly $160. And when you get that sort of share price appreciation in a very short period of time, you need a bit of a breather. So what's been happening over the past 5 months is that breather. We've also seen the tech sector come out of attack because of inflation concerns, that sort of thing. So now could be a good time to buy. I wouldn't be surprised to see the share price fall back a little bit more from here, but I'm not sure. So I think whether you buy a position in Xero is all based off your time frames. If you think in 10 years' time, the share price of this company is going to be significantly more than now, right now could be a good time to buy in. And finally, I'm just going to talk about the 1-year daily chart for Xero, not the most exciting chart for those who like the technical aspect of investing. So there's no trend here at all. If you look at the whole time period, you might say there is a bit of negative sentiment right now in Xero. And that's why we've seen the share price pull back when they released their financial year 21 results. I like to listen to the market when a company releases there's some sort of financial results. And this was definitely a negative reaction from the market. And a lot of times when you see a negative reaction from the market, you stay out until you see that sentiment shift. So there's a lot of people interested in buying Xero right now because the share price has pulled back and I think there is good value here. I probably would argue, based off the growth rates I've shown you a few slides ago, there could be good value right now. But in my investing strategy and philosophy, I'd stay out of Xero right now simply because of that negative sentiment, simply because the share price has decreased a fair bit. I'd like to see sentiment shifting and I like to see a new uptrend developing before I bought into a company. If I was a long-term buy and hold sort of investor, now could be a good time to buy in simply because there might be some value right there. So I think it all comes down to what sort of investor you are, whether you take a position in Xero or not. That's all I got on this video of Xero's financial year 21 results. If you have any questions about Xero or any other questions about any other company on the ASX or maybe the NASDAQ, leave it in the comment section or answer anything you have to say. I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. See ya.